Welcome back to your Mortgage Minute by OnLendHub. I'm Sarah, and today we're doing a deep dive on how to plan your renewal. If your mortgage is coming up for renewal this year, the big question is no longer, what rate did I get last time? It is, what does my new payment do to my monthly budget? Our mortgage expert, Muli, is here to answer some big questions and discuss effective strategies. Muli, why are renewals feeling so much heavier in 2026?
Because we are in a very different reset environment. The Bank of Canada has held the policy rate at 2.25%, but that does not translate into cheap fixed rates because 5-year Government of Canada bond yields are still putting upward pressure on lender pricing. On top of that, the Bank of Canada has said 5-year fixed mortgages renewing in 2026 are likely to see average payment increases of about 20%. That is a cash flow problem, not just a rate problem.
Give me a real example. What does a 20% jump actually look like for a homeowner?
Take a $500,000 mortgage amortized over 25 years. If the payment was roughly $2,300 a month at the original rate, a 20% increase pushes it to about $2,760. That is an extra $460 every month, or $5,520 a year. For a household with tight GDS and TDS ratios, that can be the difference between comfortable and stressed.
What if someone has a larger balance, say $750,000?
Then the shock is even more visible. If the old payment was about $3,450, a 20% increase adds about $690 a month. Over 12 months, that is $8,280 in extra carrying cost. If the household also has car payments, daycare, or a line of credit, the renewal can quickly become a budgeting event rather than a rate shopping exercise.
So how should listeners decide whether to shorten, extend, or hold their amortization at renewal?
Use a 3-part framework. First, if the new payment still fits within your budget with room for a stress buffer, keep the amortization disciplined and avoid stretching for comfort. Second, if the payment increase pushes your ratios too high, extending amortization can restore monthly breathing room. Third, if you have income growth coming within 12 to 18 months, a temporary extension can be a bridge, not a permanent decision. The key is to choose the structure based on cash flow first, not just headline rate.
What is the red flag people miss most often?
They compare the new payment to the old one and stop there. The real red flag is ignoring total household cash flow. A borrower who says, I can absorb another $300, may already be under pressure from groceries, taxes, insurance, and other debt. Renewal is the time to look at the full picture, not just the mortgage line item.
Can you break down one more example, maybe for a borrower trying to reduce the payment shock without changing the home?
Sure, suppose a homeowner owes $600,000 and has 20 years left. If they renew and keep the same remaining amortization, the payment might rise sharply. If they extend back to 25 or 30 years, the monthly payment can fall enough to create room. For example, if the extension lowers the payment by $350 a month, that is $4,200 a year back in the household budget. The trade-off is slower principal paydown, so the question becomes whether short-term stability is worth more than faster equity buildup.
So what are the practical steps listeners should take right now?
First, get the renewal statement early and compare the new payment against your current budget, not your old rate. Second, stress test the household at a payment that is at least 15 to 20% higher. Third, ask whether you need a temporary amortization reset, a different term length, or a lump sum strategy before renewal. And fourth, do not wait for the maturity date. Renewal decisions are easier when you have time to compare offers and model the monthly impact.
That is the key message. Renewal is not just a rate decision, it is a cash flow decision. Keep an eye on the payment, know your numbers, and plan early. That is it for this episode of your Mortgage Minute by OnLendHub.